Welcome back, everyone. Why Hoppers happens to be the specific catalyst AMC needs to stabilize their upcoming quarter. I noticed in my research that AMC CEO Adam Aron has been aggressively promoting Hoppers directly on his own social media accounts. In my view, is that typical for a theater executive to single out an individual movie release like that? In my opinion, it's actually a highly calculated move. When a chief executive publicly champions a specific title, they are sending a clear signal straight to the shareholders, like a confidence boost. My analysis suggests that by doing this, he is reinforcing investor confidence, reminding the market that the theatrical model is still robust, and more importantly, that AMC is perfectly positioned to capture that upcoming surge in revenue. The data definitely seems to back up those optimistic projections. I mean, Hoppers is currently sitting at a 97% critic score on Rotten Tomatoes, which is huge. A high score is great for the marketing department, but in my view, how does a number like that alter the actual financial trajectory for a theater chain? My analysis suggests it completely changes the revenue curve. In today's industry, we regularly see tentpole blockbusters drop off by 60 or even 70% in their second week, creating that steep second-week cliff. But rave reviews and near-perfect scores generate a very specific type of sustained momentum. For AMC, that 97% guarantees the film will have incredibly long box office legs, meaning they avoid that cliff and keep auditoriums full well into April as positive word-of-mouth spreads. It is really interesting looking at the voice talent they secured to help sustain that momentum too. For a family-oriented animated feature, they went surprisingly heavy on adult-skewing A-list actors. They really did. We're looking at Dave Franco, Jon Hamm, and Meryl Streep leading the roster. In my view, that casting is a deliberate part of the formula. When you combine prestigious names like Streep and Hamm with the established Pixar brand, you create a very powerful multi-generational draw. So it's not just about getting kids into the seats. The strategy maximizes ticket sales across every demographic. You are capturing the core family crowd, but you are also drawing in adults on a weekend night out and casual moviegoers who might otherwise just skip an animated feature entirely. My analysis brings us to the financial calendar. The sources highlight the film's Friday, March 6th release date as a key factor here. That gives AMC a much-needed spark for their Q1 box office numbers, because Q1 is traditionally a bit of a dead zone for the industry. A hit during that specific Q1 window is crucial because of what the industry calls the concession stand multiplier, the real moneymaker. As we know, theaters don't keep the bulk of the ticket sales. Their bottom line relies entirely on concessions. But the demographic of the audience changes the math entirely. Think about it. An adult drama might sell 2 tickets and those 2 adults might share 1 small popcorn. But a widely appealing Pixar movie brings in families of 4 or 5. So instead of 1 shared snack, families are buying multiple kids packs, large popcorns and sodas. The snacks to ticket ratio just grows exponentially. That multiplier effect is the ultimate profit driver. The family demographic doesn't just fill seats, they drive the highest margin transactions at the concession stand, which is exactly what AMC's balance sheet requires right now. Okay, let's move on. GME. Jane Street Group holds over 1.84 million put options against GME, which is a massive position valued at roughly $36.9 million. On the surface, that looks like a huge, aggressive short bet. It certainly reads that way if you isolate the dollar amount. But what's fascinating here is the broader context of their balance sheet. It completely changes the math. When I actually look at their filings, that $36.9 million represents a microscopic 0.01% of Jane Street's total portfolio. 0.01%. It is essentially a rounding error for a firm of that size. They aren't taking a high conviction directional bet on GME going down. So what are they doing with all those puts then? As a giant market maker, they operate a lot like a casino, just trying to balance the books. They're likely just staying delta neutral. In my view, they're holding these puts to hedge against their broader derivatives exposure rather than shorting the stock out of a specific belief that it will drop. That casino analogy makes sense, but if I look at the recent flow, they just added 140,400 new puts to that position. If you're scanning the options chain and seeing a firm stack on over 100,000 new puts recently, doesn't that at least signal a sudden bearish shift in their outlook? Not necessarily. My analysis actually gives us the historical data to prove it. Jane Street has held a GME put position since the first quarter of 2015. They haven't suddenly panicked or formed a new thesis. They've been running and automatically adjusting this specific hedging algorithm for 9 years. So through all the craziness, think about what GME has done since 2015. They've maintained this automated strategy through massive historic upward rallies without stepping in to manually liquidate. So those 140,000 new puts are just the algorithm dynamically rebalancing. Precisely. It's literally just business as usual, a mechanical adjustment to manage broader tail risk across their entire portfolio. Not a human trader suddenly deciding GME is overvalued. Here's where it gets really interesting. While Jane Street is running this fractional automated hedge, the options chain shows a completely different strategy playing out just a few rows down on the datasheet. You have Tidal Investments LLC increasing their call options by a staggering 478.13%. It's just massive. They added over 1.6 million calls. That's not a rounding error or a passive hedge. That is a highly aggressive, concentrated upside bet. And it's not just the aggressive funds either. Legacy institutions are actively accumulating long exposure too. UBS Group AG increased their long share positions by 4.22%, and Bank of New York Mellon bumped theirs up by 1.89%. If I connect this to the bigger picture, it highlights a stark contrast in the data. You have one massive firm maintaining a 0.01% routine structural hedge, while at the exact same time, heavy hitters are actively stacking bullish options and accumulating shares outright. In my opinion, the underlying current in this analysis actually leans heavily positive. In my opinion, for AMC CEO Adam Aron publicly championing hoppers is not random promotion, but a calculated signal reinforcing confidence in the theatrical rebound narrative, especially during a traditionally soft Q1 window. A 97% Rotten Tomatoes score materially improves the probability of long box office legs, reducing the typical second-week revenue cliff and sustaining high-margin concession traffic, which is the true earnings engine for exhibitors. A multi-generational animated release with recognizable A-list voices increases per-visit spending through the family concession multiplier effect, potentially stabilizing quarterly cash flow at precisely the right time. On the GME side, the optics of Jane Street Group holding 1.84 million puts initially appear bearish, but context transforms that narrative. A $36.9 million position, representing just 0.01% of portfolio exposure, strongly suggests systematic delta-neutral hedging rather than conviction shorting. Their continuous presence since 2015 reinforces the mechanical, algorithmic nature of the trade, making the recent addition of 140,400 puts more consistent with routine rebalancing than directional pessimism. Meanwhile, aggressive upside positioning from firms like UBS Group AG and Bank of New York Mellon, accumulating long exposure, alongside substantial call increases from other investment entities, creates a constructive divergence. Structural hedging on one side, active accumulation on the other. When viewed holistically, this alignment suggests underlying institutional confidence rather than systemic doubt, reinforcing a positive bias toward both AMC's near-term revenue stabilization and GME's broader positioning dynamics.